Patience is not always a virtue in investing. Patience is widely celebrated in investing, holding long-term positions, waiting for compounding, and avoiding impulsive trades. Yet research and market experience show that patience is not inherently virtuous. Timing, context, and adaptability matter as much as waiting. 1. The risk of passive inaction. Being patient can turn into inaction. Holding underperforming assets too long. Ignoring changes in fundamentals. Failing to rebalance portfolios. Economist Richard Thaler highlights that inaction bias can harm returns. Patience without evaluation may lock in losses rather than create gains. 2. Opportunity cost of waiting. Time spent waiting for an ideal market entry or perfect signal has a cost. Missed alternative investments. Lower overall return compared to more active, but disciplined allocation. Delayed compounding. As Howard Marks notes, opportunity cost is the silent killer of passive patience. 3. Patience can be misapplied. Not all situations reward waiting. A declining company's stock may continue to erode. Trends in markets can reverse faster than anticipated. The liquid or speculative assets may never recover. Blind patience can be harmful if not combined with strategic evaluation. 4. Context matters. Patience becomes valuable only when applied wisely. In diversified, low-cost, long-term portfolios, it reduces trading costs and emotional mistakes. In concentrated, high-risk positions, patience without monitoring increases risk exposure. Warren Buffett emphasizes informed patience, waiting while knowing what you own and why. 5. Behavioral implications. Patience may sometimes be a justification for avoidance. Fear of making a decision. Ego protection, not admitting mistakes. Overconfidence in a desired outcome. Investors can confuse deliberate patience with passive stubbornness, leading to financial harm. 6. Balancing patience and action. Effective investing requires both. Strategic patience, holding positions with conviction and monitoring. Judicious action, cutting losses, reallocating, capturing opportunities. The best investors combine the two, rather than blindly waiting. Conclusion. Patience is not an unconditional virtue in investing. Unexamined waiting can magnify losses. Opportunity costs can erode gains. Context determines whether patience is beneficial. In finance, wisdom lies in knowing when to wait, when to act, and when to adapt. Key insight: patience is a tool, not a rule. Used wisely, it compounds wealth. Used blindly, it compounds mistakes.